SoFi Technologies has captured the attention of many retail investors, and for good reason. There are two key factors driving this interest. Firstly, SoFi is seen as a fintech company with immense potential for future growth, but let's delve into that a bit later. Secondly, SoFi's current stock price sits significantly lower compared to its 2021 highs. Back in 2021, SoFi stock soared to a high of $28 and remained near that level throughout the year. In November of that year, it was still trading around $25. However, the stock then experienced a dramatic plunge, dropping as low as $4.25 within the next year. This significant drop sparked a buying frenzy among retail investors. While the stock has partially recovered since then, it's currently trading within a range of $5 to $11 for the past year. Right now, you can find SoFi at around $7 per share. So, is this a good entry point? We believe it could be. Why? Remember how we mentioned SoFi's potential for growth? Well, the company is not only expanding its reach but also becoming profitable. Let's take a quick look at recent Q1 2024 results. Revenue came in at $581 million, which is up 26% year over year. Revenue was $21.1 million more than market expectations. Quarterly adjusted EBITDA came in at $144 million, up 25% year over year. If we do comparison of the results with what SoFi said for this quarter, it has been excellent. The company has exceeded all the estimates and made a net income of $88 million. However, the stock price witnessed a decline of 16.1% following the results. Obviously, market did not like something. And it was the soft Q2 2024 guidance that the company gave on the results. For Q2 of this year, SoFi expects revenue of $555 million, adjusted EBITDA of $115 million and net income of only $5 million. All of these are lower than what the company achieved in Q1 2024. Let's listen to what the CEO Anthony Noto said while talking to CNBC about the results.
I think it's important to focus on the results and what that means for the full year and then what that means for our 3-year outlook. So in the quarter, we achieved 26% year-over-year growth in revenue, $581 million. We had 25% EBITDA margins. We grew that almost 100% at $144 million. More importantly, we have grown tangible book value per share 16% sequentially by about $600 million. We had record deposits of $3 billion and really strong overall performance. The most important thing about those trends that I'd point out, and the reason why 2024 is a transition year, is the growth was driven by low capital, high return businesses, our technology platform business, and our financial services businesses. Those two businesses, when combined, grew 54% year over year against lending that was flat. As we came into 2024, given the uncertainty in rates and the economy, as well as liquidity for the industry, not us, and despite having excess capital, we made a decision to put the resources behind these high return businesses that actually are big enough now to drive our overall growth and profitable enough to do that. And so that's the key message coming out of the quarter, is that transition is taking place and going incredibly well, which sets us up for a great 2024. We actually raised 24 revenue guidance by more than our beat.
Noto emphasized that 2024 is a transition year for SoFi. The company is shifting its focus towards low capital, high return businesses such as technology platform and financial services, which showed significant growth, 54% year over year, compared to lending, which remained flat. Despite having excess capital, SoFi made a strategic decision to allocate resources to high return businesses due to uncertainty in rates, economy, and liquidity, positioning itself for future growth and profitability. Now here, we would like to explain that SoFi Technologies' business model runs on 3 segments. These are lending segment, technology platform segment and financial services segment. For Q1 2024, adjusted net revenue from lending segment was $325 million. For trading platform segment, the revenue was $94.3 million and finally, the financial services segment net revenue was $150.5 million. As we can see, major portion of revenue for SoFi is coming from lending segment. But the company is trying to shift away from this segment and focus more on the other two segments. These segments have greater chances of profitability and lesser risk than the lending segment. SoFi Technologies had 10.1 million financial services products on offers at the end of Q1 24, reflecting a year-over-year growth rate of 42%. Lending products, on the other hand, only saw 20% growth. Since SoFi is a growth stock, current price-to-earning multiples cannot be used to judge the true value of this company. However, 2 years from now, in 2026, SoFi is expected to generate an EPS of 44 cents based on estimates of 6 Wall Street analysts. This implies a price-to-earnings ratio of 15x for this fintech stock. SoFi's story is like a captivating drama series with a loyal fan base, but Wall Street remains unconvinced. The company has made impressive strides, but the market seems hesitant to shower it with awards or stock price increases just yet. Sure, there are financial giants like JP Morgan Chase lurking in the shadows, with resources to make even the most dedicated SoFi fan wobble. But SoFi's secret weapon is its members, a loyal and growing community who are lapping up their innovative products and seamless user experience. Will SoFi win over the cold, calculating heart of Wall Street? Only time will tell, but one thing's for sure, with a passionate fan base and consistent member growth, SoFi's future is anything but dull. Buckle up, this fintech saga is just getting started. Adding another layer of suspense to SoFi's drama is the recent rise in interest rates. This has Wall Street worried about a potential surge in loan defaults, which could hit SoFi's bottom line hard. It's a valid concern, as higher rates can make it tougher for borrowers to repay loans. However, this could also be a temporary hurdle. If SoFi can navigate these choppy waters and maintain its underwriting standards, it could emerge even stronger once interest rates stabilize. In that scenario, SoFi's loyal user base and innovative approach could lead to a significant stock price appreciation down the road. So, is the market overreacting to the short-term risk, or is there a reason for caution? Only time will tell how this episode of the SoFi saga unfolds. So, is SoFi a dream waiting to be realized, or a gamble with an uncertain outcome? The answer, like any captivating drama, lies in the future. However, with a strong user base, innovative products, and a potential future fueled by lower interest rates, SoFi's current price around $7 might just be the opening act of a much bigger story. Now, remember, all investments carry risk. But for a small portion of your portfolio, say 2 to 5%, SoFi's risk-reward profile starts to look enticing. Consider this: you could buy shares outright, or explore strategies like selling put options with a $7 strike price expiring in a year. This allows you to collect premium while potentially acquiring shares at a discount. Call options are another strategy, offering leverage and limiting your downside risk. Ultimately, the decision is yours. This video aimed to equip you with the knowledge to make an informed decision. So, will you join the SoFi saga? The curtain is rising, and the opportunity awaits. Thanks for watching.